Welcome to Prime Life. We call it Retirement 2.0. Leave each episode with tips and new ideas to help you navigate retirement in our new age. It's your time. Make it count.
This podcast is for educational purposes only. It is not intended as medical, investment, or financial advice. We do not sponsor or endorse any of the individuals, companies, products, or services featured on this podcast. Any statements or opinions expressed are of the individual who makes them. We hope you enjoy the episode.
Hello, everyone, and welcome to this week's episode of the Prime Life Podcast. This is Joseph, and I am here again with my co-host, Mary. Mary, before I ask you how you're doing, I just want to share one thing. The other day, I saw this shower thought, which I think is just perfect for today's show. So if you don't mind, I'm going to throw that out at you and then ask you how you're doing. Sound good?
It sounds very good. Well, I always say the same thing. Go ahead. Go for it.
There you go. The older you get, the less money you need to retire for the rest of your life. Think about that one. Okay, Mary, how you doing? And let's get the show started.
I'm outstanding because I'm here with you as usual. And we have a very interesting guest. So I believe your quote or your saying is going to definitely be a great segue. Today on the Prime Life Podcast, I'm pleased to introduce Ron Surz. He has a lot of titles, so bear with me. He's the president of Target Date Solutions. He's developer of the patented safe landing glide path, Ceteria personalized target date accounts, and Age Sage do-it-yourself investing. We're not done yet, though. He's also the co-host of the Baby Boomer Investing Show, and he's an author. Ron, welcome to the Prime Life Podcast. Please tell us a little bit about yourself.
Thanks, Mary. Yeah, so I'm involved in a lot of things, but what I'd like to do while I'm with you today is just cover three topics, if we have time, in this order. I'd like to talk about investing for baby boomers, and I'm the oldest baby boomer, so I'm in that group. Then I'd like to talk about 401k investing, and in particular, the most popular default investment, and I'll define what default is, but the most popular investment in 401k plans is what's called a target date fund. And your listeners may or may not know what that is, but I'll take a minute and talk about that. And then I'd like to talk about what my sister is doing for older senior women. She's got this development called the Golden Life Community, and it's really spectacular. So I hope we have time to go through all three of those things. But those are the things I'm involved in. In my past, I was involved mostly with defined benefit pension plans. I consulted trillions of dollars in that area, but those are sort of a dying breed, and now it's mostly what's called defined contribution plans, or 401k. I have 2 master's degrees, one in applied mathematics and one in finance. So I've been spending a lot of time in school. Here we are. So would you like me to get started on the idea of baby boomers?
Let's do it.
Why not? Let's do it. Why not?
So in 2019, my sister was here visiting with us in California for Christmas. And she had a really successful online show called The Dog Connection, millions of viewers. And I bemoaned to her that I thought that baby boomers were taking way too much risk, that they, at this time of their life, should be protecting their savings because they're in what behavioral scientists and financial advisors call the retirement risk zone. And that's the 5 years before and after retirement, when if you lose your money, it will spoil the rest of your life. And one of the interesting things I found in trying to help baby boomers is the Employee Benefit Research Institute, EBRI, has a report of asset allocation for different age groups. So for 20-year-olds, the report said the average investor was 60% in equities and 40% in bonds. For 40-year-olds, it was 60% in equities and 40% in bonds. For 60-year-olds, it was 60% equities and 40% in bonds. You get the idea? For 100-year-old people, it was 60-40. that 60-40 answer is so entrenched, and really I think is part of the most advisors' gospel. It's just the go-to place. That is fairly high risk for people who are going to be relying on their savings. They won't have a paycheck to rely on anymore. So I've been advocating much greater safety and fighting a battle that I'm not alone, but there are others who are saying, the stock market's way too expensive. Bond yields are the lowest they've ever been, although that's changed a little bit lately. But there are a lot of reasons to be concerned. So I agreed with Kathy, again, who's my sister in 2019, that she would help me get the word out to baby boomers, and we started a show called the Baby Boomer Investing Show. And there are 35 episodes of that now on our YouTube channel. So if you Google Baby Boomer Investing Show, you'll find us. And then I wrote a book that includes all of those shows. So in the book, I really recommend that you get the Kindle. I'm doing a little bit of promotion here, but I think it's just, if I don't, I'm going to forget it if I don't do it now. Every chapter of the book has links to the shows. So you can read, you can watch, you can do whatever works best for you. Part of all that was really screaming at baby boomers that 60-40 is probably not right for most of them. And they really need to protect their savings. Once they're out of the risk zone, basically protect for 5 to 10 years into retirement. I'm actually advocating re-risking to extend the life of the assets, which is controversial, but that one is sort of interesting in that it's based on research done by Michael Kitces, who's pretty well known to the advisor community, and Professor Wade Pfau. And they wrote an article looking for the optimal glide path in retirement. And it starts very, very safe. Now, by safe, I don't mean 60% in equities by any means. I mean probably less than 30% in equities to be safe. But then to re-risk, to extend the life of the assets. And Kitces got a lot of pushback on that, and he responded to them. He said, "Look, I know you guys use buckets, and I know that you start with a lot in the bond bucket in retirement, and then you spend that first to give the equities time to run. Now think about what that does. You're increasing your equity allocation. So you guys are doing what I'm preaching, but maybe you haven't looked at it in the way that I'm saying, but that is for sure true. So my number one message to baby boomers is you need to get safe. And then the next question becomes, so if I'm not in stocks and bonds, but I think bonds are risky now too. So, even though interest rates have come up a little bit, I think there's still plenty of reason to think that there's more to go. So
Ron,
I want to touch on inflation too. Yeah.
real quick question on that. Isn't some of the risk, related to person's net worth and their tolerance for risk? So some people maybe have high risk, high net worth, and they're more willing to take, more stocks or less stocks depending on what they're looking for. So it's not really a one size fits all, right?
Yeah, I think that's true. So, one of the things I'm going to go to is 401k plans. But let me go there. So I'm really drifting around here a little bit, but I think that's good. I agree. If you're rich, you can probably afford to take some losses. But some people say that the bigger they are, the harder they fall. So no, there's two sides to that coin. But in 401k plans, early on, plan sponsors found that they were not getting the participation that they wanted. So a new hire would come in and they say, "We got this 401k plan. Do you want to use it?" They say, "No, no, thank you." And behavioral scientists said, you need to flip that around. What you need to say is, "Congratulations, you're in our 401k plan," to automatically enroll them. And that worked. So the enrollment is way up, and that's a good thing. But then that created a second problem, and that is most of those people don't know how to invest. They don't have a clue. They're doing other things. They're running a punch press or things that are not investment related. So the Pension Protection Act of 2006, by the way, before the Pension Protection Act of 2006, if people could not make a decision, the common practice was to put them in cash, treasury bills or stable value. Then the Pension Protection Act of 2006 created what's called Qualified Default Investment Alternatives, QDIAs. And they anointed 3 default options: a target date fund, a balanced account, or a managed account. Now you would think of those 3, the managed account would be the most popular. That's the one that they're trying to do without people cooperating. So defaulted people don't want to talk to you. They don't want to engage. So that managed account option, which you would think would be pretty good, is not really very popular because it's trying to automate a decision for people who don't want to talk.
Those accounts though are being set up when people are in their prime of their working years, not when they're at retirement stage, right?
Yeah, well, they're to prepare for retirement. Yeah, they're for people during retirement. That actually brings up another question. Most people withdraw their savings when they retire, but many keep their savings in the plan. So the target date funds really need to be prepared to serve people in retirement. So that's part of what needs to be baked into what's called the glide path. Now, I haven't even told you what a target date fund is yet, so let me touch on that.
Yeah, I'm glad you were going to discuss that. Go ahead.
That's been around for a long time, mainly for college savings plans. So the adaptation of this for retirement savings is new. And what it does is it says when you're young, your horizon is long, so you can afford to take some risk, and your account balance is probably small. So if you lose 50% of a $10 account, you're still getting paychecks, so you're going to come back. But as you get closer to retirement, you need to defend, and then that's where this notion of a risk zone comes in. Now, I'm going to just stay on the target fund because I'm there now, and I'll come back to baby boomers because the baby boomers are right now mostly in the risk zone. They're the ones who are in the target date funds are, seeing the risk in those target date funds. And I've been arguing there, along with my argument for getting safer, that the typical target date fund is still too risky at the target date. And I'll even throw out a number for you that's really controversial, but you would think the glide path would become less risk through time, and it should. But all of the glide paths, except mine and a couple others, are about 90% risky assets for all people. Now, where the difference comes in is the risk is being taken for people near retirement, mostly in long-term bonds. So near retirement, the typical fund is about 55% in equities and 35% in long-term bonds. For people who are younger, it's about 90% in equities and 10% long-term bonds. So long-term bonds are there for the risk control. And this only protecting against risk if interest rates don't go up. So I've been screaming that allocation is very risky, and advocating instead for a very low risk, basically less than 30% in equities. And by the way, just to throw out another well-known entity that's in the same space as me, the Federal Thrift Savings Plan, the TSP, that is sort of well known as being very safe at the target date. So they've gotten pushback on that, but so far they're sticking to their guns. So why are those target date funds so risky? I say a couple things. One is fund companies get paid more for taking more risk. And they're not the losers when risk doesn't pay off. The beneficiaries are the losers. But second, and I think this is the most damning thing, and it's just not getting noticed, all of the target date fund companies say they follow this academic theory that looks at investment capital and human capital. So those are our two sources of wealth. We have what we own in financial markets, and we have our human capital that's basically our earning power. And there's a famous graph that sort of shows this. The human capital depletes through time because we're going to stop working and we're going to die. At the same time, the financial capital is increasing. And the notion to the academic theory is as you become more reliant on that financial capital, you need to protect it. Now I'm going to come to the punchline. I actually dusted off a 2007 article about a year ago, and I should have dusted it off sooner. The academics' version of safety when you're about to retire, you need to be ready for this, 80% risk-free assets. That is what the academic theory calls for. Now, the fund companies are saying they follow that theory. They're not. It's just not true.
So
I'm sorry,
why
go
aren't they? So why?
And we'll get that answer after a brief word from our commercial sponsors.
NASA is always working harder to be your carrier of choice. We offer insurance products that can help you meet your retirement goals, such as protecting your savings, securing lifetime income, or paying for healthcare costs. We're dedicated to providing best-in-class service and are keeping things simple, and we'll have your back. We have around 400,000 policyholders and contract holders and have been doing this for a long time, 170 years, but we remain humble enough to always try to improve. For more information, visit nfg.com. NASA insurance products are issued by Nassau Life and Annuity Company of Hartford, Connecticut, Nassau Life Insurance Company, East Greenbush, New York, or Nassau Life Insurance Company of Kansas, Overland Park, Kansas. Subsidiaries of Nassau Financial Group. Products are not available in all areas. Policyholder counts are for all Nassau companies as of September 30th, 2022, and are subject to change. Aren't they?
I think it's profits.
Mm-hmm.
I have a more practical question. So say a person invested in a target date fund, they're now hearing this discussion and they're like, well, this isn't right for me. What should they do?
Get out. I mean, right now, my version is not available to them. So actually it is. They could get out and go to my do-it-yourself webpage that will guide them through what I think is right. But I don't want to be too promotional here.
Yeah. Can you talk a little bit about that? Like, what does that entail, the do-it-yourself? And again, it's not for everyone, but I would like to hear a little bit about how that works. High level.
Mechanically, it's pretty easy. You go to my website, and there's a tab there it's called Age Sage. And it invites you to tell me how old they are, when they plan to retire, a couple of other questions. And then it also says, what investment firm would you like to use? And I recommend using the lowest expense. But you can say, I want to use Vanguard. I like Vanguard. I want to use Fidelity. Whatever I want to use. And then I ask you to pay me $50. And I also warn you that this is on you. You can decide not to take it. To take it is just sort of it's educational, because I really don't want to be held to. The user needs to make their own decision. But once they see, know what I'm doing there, and it's just well diversified. For people who are young, it's pretty aggressive. People are old, it's just not. But I thought if I gave it away, people would not respect it. So there's a charge to get the solution. You can buy packages if you want to get. If you're an advisor and you want to buy 100 solutions, you can get a package for that.
So you're not providing financial advice; you're providing educational information.
That's exactly right. The people who get on the site before they can participate, they need to say that they read the disclaimer, but nobody reads it. But the disclaimer says that. I'm trying to educate you. Now, I will say, the fund companies who are taking this high risk at the target date, and they're well known: Vanguard, Fidelity, T. Rowe. Actually, those three companies manage 70% of the $4.5 trillion in target date funds. It's an oligopoly. It really is an oligopoly. And they say you haven't saved enough, which is generally true. And they say, so you need the medicine of high risk because you're going to outlive your assets otherwise. And that might be true. And I will
I
say,
actually think, I mean, I'm not a huge fan of target date funds, but that's a different conversation. But
yeah, okay.
you could take more risk, right, by putting more into straight up equities that, have a little bit more risk, small cap or whatever it might be, and roll the dice if that's what your risk tolerance is for.
Yeah, I agree. But remember, this is default. So this is for people who don't want to think, they don't want to engage, they don't know how to invest. And basically, they're relying on their plan sponsor, their boss, to make a decision for them. And that's really a tough decision, especially, when they say, I don't know. You're going to have to tell me because I just don't know. So that's the nature of the target date, all of the default investments.
But again, like most of these people are going into those default target date funds are, let's just say, somewhere between 20 and 50, right, on average.
They're generally younger. Their account balances are smaller. The fact that they're less wealthy and uneducated about investing anyway, again, argues for safety. It doesn't argue for
No, yeah, for
going
sure.
for the fences.
The less you know, the more safety you look for. So why, go through your process versus choose one of the 100,000 plus advisors that are out there selling various products and services?
Yeah, if I were the same, I wouldn't be talking to you. There's so many flavors of vanilla out there. I mean, the industry they've wrapped their arms around Vanguard, and Vanguard is a very thoughtful firm, and to deviate too much from the Vanguard glide path, really, they become the standard. They become the de facto standard, and there needs to be another standard. I've just written my third book on target date funds, and it has some advice about there's no standard benchmark, but the de facto has been Vanguard. There needs to be at least one other, and it needs to be low risk rather than high risk. But to answer your question, that the industry is extremely uniform. It's just a lot of would-be wannabes.
I know you mentioned a conversation with Kathy, and Kathy is going to be on our podcast
Yeah, great.
coming up.
Yeah.
But when did that light bulb for you go off that you said, I see a need in the market for individuals that really want to be educated, that, as Joseph and you alluded to, that maybe that younger age group, but also you also alluded to baby boomers. There's not a lot, they may be retired. They may not have that paycheck anymore. When did that light bulb go off for you?
Well, I want to say 10 years ago, and my wife says I'm a perma bear. I've been worried about boomers for at least a decade. And I think part of that happened when I moved over from defined benefit plans to defined contribution. And the big distinction there is obvious. It's with defined benefit plans, your boss, your employer, was responsible for taking care of you. When the move went to defined contribution, the onus really became on the plan participant to run their own money, basically. So I have been concerned. My concern has been heightened, and it's not going away, because one of the articles I wrote is called "The 22 Reasons to Be Concerned." And I'll state the obvious ones first, and then some that are more nuanced. But there are wars going on, and that's really good for our defense industry. But and I watch Tucker Carlson all the time. I don't know if you like him or not, but he's
Getting
basically
political, are we?
a little bit. But no, his thesis has basically been the politicians love war. They think it's good for them, and anyways, it's not good for humanity. So those are going on. We've got serious inflation, and that's a little nuanced. So the 9% that we saw a few years ago was demand pull inflation. So the cargo ships were not getting unloaded, and that was COVID based. So that went away, and I don't think the Fed needed to do anything, and that would have gone away because the cargo ships started to get unloaded. But there's another form of inflation called cost push, and that's when there's too many dollars in the economy. So you've probably followed this, but if you watch what went on with COVID, first of all, we were already sort of printing money, but COVID stepped that up huge. So in normal times, this is sort of a measure of the amount of money in the economy. In normal times, when the Treasury issues its securities, bonds, and Treasury bills and so on, there are plenty of takers. But when it starts to issue what more than is being taken up by investors, it may surprise you, but the Federal Reserve steps in and buys those. So the measure, I think, of sort of what's going on with printing money is looking at the Federal Reserve balance sheet. And it was about $1 trillion on average. Then it went up to about $4 trillion as we were doing some quantitative easing, trying to stimulate the economy. With COVID, it went up another $5 trillion to $9 trillion. That was the Fed's balance sheet until a year ago. Then when the Fed moved to lower interest rates, it let some of those bonds it held mature. Now, that's the part the Treasury can actually pretty much clear at the short end of the market, Treasury bills. But at the long end of the market, the Fed has needed to step in to control the long-term interest rates. And they basically would buy long-term interest rates to keep the interest on those down. That was called zero interest rate policy, ZIRP. But as part of its quantitative easing quantitative tightening rather than easing, it let those bonds mature. Now, I'm only bringing that up because this is a nuanced thing, but it's sort of fun. So the Fed lowered interest rates, but the yield on 10-year bonds is going up. And you look at it and you go, so yeah, short-term rates are going down. That's what the Treasury said it was going to do. But the long-term rates are going up. The reason for that is the Fed is letting those bonds it holds mature. So the market is setting the long-term rates now, which is really pretty interesting. So we've got a history of zero interest rate policy where the Fed was manipulating bond rates to stay low. Now that it's sort of taking its foot off the brake, interest rates will probably go up. So I think the bonds do create risk. The stock market, by many measures, is more expensive than it's ever been. But one of the ones that's really worked well is called the Buffett measure, Warren Buffett's measure. And it tracks the ratio of the value of the stock market to gross domestic product, GDP. And it is right now as high as it's ever been. It's not higher than it's ever been, but it's as high as it's ever been. And getting higher. Now the market's going up because the market seems to like that Donald Trump got elected. I think in some ways it probably just likes the finality of knowing who the president's going to be. So that's all a good thing.
Right. So, Ron, what do you see in the next several years in terms of the challenges and the opportunities that individuals could consider?
I think we might see a stock market crash that's worse than anybody thinks it is. And I think we're being gaslighted into thinking that is inconceivable. It just couldn't happen again. So there's this concept called a Minsky moment. Hyman Minsky, an economist, sort of said something that it has rung true, but it's sort of, as asset prices get bid up, the way down can happen really quick and really bad. So I think the roaring 20s, 1920s, is happening again in the roaring 2020s. And I don't want to be a doomsayer, but what I'm saying is baby boomers in particular need to get out of the way. If I'm wrong, so you've missed an opportunity, but at least you're out of the way. If I'm right, you need to send me your thank yous at least, and maybe more. So one of the things I hear when I say this could be much worse than you think, and I'm not the only one who's saying it. There are well-known people are saying the sky is falling.
Well, nothing goes up forever. That's a fact.
Well, there's a famous quote: "Is if it can't go up forever, it won't."
Right. We've seen multiple corrections over time.
Yeah,
we have.
And this current 15 years, you forget 2022 is a little blip, has been the longest bull market ever. 15 years. This is as long as we've ever seen. So no, I think the pressure is building up on a correction.
So, Ron, I know when we started this chat, you mentioned 3 areas you wanted to cover. We're sort of getting a little bit short on the time, so we may have to follow up on that third topic at another date. But before I hand the mic over to Mary for her final question of the day, please let our listeners know how they can get in touch with you, learn more about you. You know, you mentioned 22 reasons.
Yeah.
You only went through one, so I'm sure people want to read the other 21 of them. So what's the best way for them to find you?
Well, I'm easy to find at Target Date Solutions, but I also have been writing articles on 401k Specialist magazine. So, please look for me there. One of the things I wanted to cover was people say, so if I shouldn't be in stocks and bonds, what should I be in? Let me do a quick thing on that because I don't want to deprive people of the answer to that question. I look to the Talmud, although I'm not Jewish, but in the Talmud, the advice is a third in land, a third in business, and a third in reserve. And I think that works here. And the third in reserve would be Treasury inflation protected securities. So buy something that protects against inflation. The third in land is obvious. It's real estate. And I think it should be global real estate. And then the third in business, I don't think should be stocks or bonds. I think it should be things that protect against inflation, precious metals, farm real estate, things like that give you some growth potential, but are not exposed too much to the stock market and give you some insulation against inflation.
So you're not a fan of fine art investing and crypto and...
No, actually crypto I like. I actually that's in my solution that qualifies as something that gives you some participation, but gives you some protection against inflation. Yeah, and so it's all in the mix.
I think what you said today is very interesting.
Thanks.
I think what I'm hearing, Joseph, would love your input here. It's not one size fits all, but it's that balance and, keeping the retirees' money safe, keeping all of our money safe, not just those that are approaching retirement or in retirement, but everyone's money, keeping it safe. Our last question for you, Ron, is this. Here it comes. So you've done a lot of interesting things. You do a lot of interesting things. You could do anything at all. Why do you wake up every day and do what you do? What is your why?
My why is to get the word out to my fellow baby boomers. I think it's important. And I will say, things like your show help, but I don't think enough people are listening. And I expect when the market next crashes, there will be an outcry for people in target date funds in particular who are going to lose a lot of their money. That happened in 2008. When the market was down, the typical 2010 fund lost more than 30%. More than 30%. But there was only $200 billion in target date funds then. Now there's $4.5 trillion. So I think it's going to be terrible. And as much as I can warn people, that makes me happy, makes my day. So I sort of retired. We moved to Southern California 20 years ago. And one of our shows on I'm drifting here a little bit. We did 3 shows on retirement happiness. And one of them was this fellow who wrote a book called Retirement Heaven or Hell. And he tells a story where he was forced into retirement. He was mad. But since he was retired, he did what his mother was doing. So he watched TV and sat around and did nothing. And he said, that was hell. But for my mom, that was her heaven. She planned all her life to do just that. And she was very happy. So the moral of his story in his book, and he lectures now on this thing, his name is Mike Drack, is we need a purpose. And without that, we're not going to be happy. And your purpose can be to do nothing, but that's probably not most people's purposes. So that's my purpose, is getting baby boomers protected.
Having a purpose is a great way to end today's show, and just don't have a target on your back by. So thank you, Ron, Mary. Great conversation. I encourage everyone to check out the show notes, learn more about Ron and the work he's doing. Thank you all for listening. Make sure you like us, share us, tell your friends, and if you have ideas for shows, get in touch. Thank you all again for listening, and have a great day.
Yeah, thank you.
You as well. Thank you.
Remember to subscribe to the Prime Life Podcast anywhere you find podcasts. You can find all of our episodes, contact information, and more on our website, primelifepodcast.com. Stay connected with us. Follow us on LinkedIn, Instagram, Facebook, and TikTok.